If you've ever tried to start investing, you've probably heard this advice. Just keep putting money in and wait. But what if wait actually means half a lifetime? Because for most people, that's the painful truth. The typical path to financial freedom is so slow that by the time you get there, you're too old to enjoy it. If you run the numbers, the income they're waiting for might not show up until their 70s or even 80s. In this video, I'm breaking down why that happens and how you and John can build a dividend portfolio that works faster, not riskier, just smarter. You'll see exactly why the S&P 500 can't get you there, what kind of stocks can, how to build your own income-focused portfolio, and how even $10 a day could snowball into $3,200 a month in under 2 decades. Stick around until the end, because I'll show you how John's plan hit $3,200 a month 49 years faster than the classic approach. And with just one simple change, he made it grow even faster, turning it into the quickest, most doable way for everyday investors to reach it. Now, before doing anything, John defined his goal. $3,200 a month in dividend income, enough to cover the basics, rent, groceries, utilities, and breathe a little easier. Now, when you break that number down, it really comes down to one thing: yield. Think of yield as how much cash flow your investments pay you each year. The higher the yield, the less total money you need invested to hit that same income goal. At a 3% yield, you'd need roughly $1.3 million. At 4%, it drops to just under $1 million. At 5%, you're closer to $790,000. Same goal, totally different climb. But let's be real. Nobody has a spare million sitting around waiting to make them $3,200 a month. If you're aiming for that kind of income, it's not about having money, it's about building it. And that's where John realized something most people overlook. It's called dividend reinvestment, or DRIP. Instead of cashing out your dividends, you use them to buy more shares. Those new shares then pay dividends too, and over time, that snowball starts rolling faster and faster. Here's how it works. Say you start with $50,000 invested in a stock priced at $25 a share. That gives you 2,000 shares. The dividend yield is 4%, so in the first year, you'd earn $2,000 in dividends. Instead of spending it, you reinvest and buy 80 more shares. Now those shares pay a little more, and your second-year dividend comes to around $2,080, and that gets reinvested too. Each year, your pile of shares grows, and so does your income. Without adding another dollar of your own money, your dividend income grows every single year. DRIP turns dividends into compounding machines, pulling forward the day when that $3,200 a month becomes reality. Now, if you've ever asked for investing advice, chances are you've heard the same phrase repeated 100 times. Just invest in the S&P 500 and wait. It's the golden rule of personal finance. Safe, simple, and time-tested. And to be fair, it's not bad advice if your only goal is to grow wealth slowly over the course of a lifetime. But John's goal isn't just to be comfortable at 70. His goal is to build an income stream he can actually live on while he's still young enough to enjoy it. So he digs into the numbers. The S&P 500 has a dividend yield of about 2.5%, a 10-year dividend growth rate of around 6%, and share price appreciation averaging 11% a year. Those numbers look good for long-term net worth growth, but when you run them through the lens of dividend income, the picture changes. So to keep things realistic, he decided to start small, just $10 a day. That's about what most people might spend on lunch or coffee. No giant lump sums, no inheritance, no big paychecks to fund it, just a small, consistent amount that anyone could actually stick with. With that mindset, John set out to see what the S&P 500 could really do. He started investing $10 a day, roughly $3,650 a year, into a basic S&P 500 index fund. The projections show that after 10 years, his portfolio would grow to around $67,000 and pay roughly $1,000 a year in dividends. It's progress, but not exactly life-changing. After 20 years, the projections show a portfolio value of about $275,000 with annual dividends of roughly $2,000. Still not enough to make a real difference. By year 30, the projections show John crossing around $900,000, earning about $5,000 a year in dividends, which is about $400 a month. Still, nowhere near the $3,200 target. In fact, to actually reach that target, John has to stay invested and contribute $10 a day for 68 years. That's when his dividend income would reach $38,500 a year or $3,200 a month. So yes, the S&P 500 works. It builds wealth, it compounds beautifully, and if you wait long enough, the dividends will eventually cover your expenses. But the problem is the clock. It takes nearly 7 decades to get there. For John, that meant financial freedom wouldn't show up until he was close to 100 years old. And the reason is simple, it's the shape of the curve. Compounding always feels slow in the early years and then explodes at the end. With the S&P 500's low yield, most of that exciting growth doesn't show up until the last chapters of your life. The problem isn't that it doesn't work, it's that it works too late. That's why John starts looking for an alternative, a portfolio with a stronger starting yield, steady growth, and earlier compounding. One that bends the curve upward within the first 2 decades. So the next question was obvious. If the S&P 500 moves too slowly, how do you pick better stocks that build income sooner? Well, next, I'll show you how to select the stocks for your goal. Then I'll show you how a portfolio of those stocks can reach the same goal in 19 years, not 68 years. And finally, I'll show you how to reach it even quicker in just 14 years. After seeing how slow the S&P 500 was at building real income, it's clear that the answer isn't to stop investing, it's to invest smarter. Most beginners make the same mistake. They chase the biggest dividend yields they can find. On paper, those high numbers look great, but in reality, they often come from companies in trouble, and those payouts don't last. So the goal isn't chasing yield, it's finding balance. The first thing to focus on is dividend yield itself. How much a company pays shareholders each year compared to its stock price. Too low, like the 1% range of the S&P 500, and the income takes forever to grow. Too high, and it's usually a warning sign. The sweet spot is somewhere in the middle, roughly 3 to 5%. That range provides solid cash flow today without putting the business at risk. Next comes dividend growth, a payment that never increases, loses its value over time as inflation eats into it. The best companies raise their dividends every year, ideally by 10% or more. That steady growth is what makes your income snowball gain speed over time. But growth only works if it's sustainable. That's where payout ratio matters, the percentage of profits a company uses to pay dividends. If that number's too high, there's no cushion when things go wrong. Ratios under 70% usually strike the right balance, leaving room for the business to reinvest while still rewarding shareholders. Beyond the numbers, it's about strength and stability. Companies with healthy balance sheets and consistent cash flow tend to keep paying through recessions and tough markets. Diversifying across industries, finance, real estate, consumer goods, and growth sectors helps protect your income if one area slows down. Using these criteria, John started handpicking stocks that checked every box: balanced yield, strong growth, and consistent dividend history. Each company had a purpose in the bigger plan, and together they formed what he called his optimized dividend portfolio. At the foundation sits the Schwab U.S. Dividend Equity ETF, or SCHD, a basket of high-quality dividend payers with a yield of about 3.88%, a 10-year dividend growth rate of roughly 10.4%, and steady price growth of around 7.7% annually. This fund anchors everything else: diversified, stable, and built on reliable companies with long dividend track records. Then comes Morgan Stanley, MS. Its yield may look modest at 2.57%, but the growth behind it tells a different story. More than 22% annual dividend growth over the past decade and price appreciation close to 17% a year. That combination makes it a quiet, compounding machine. Next is Tractor Supply, TSCO, incredibly consistent. Its dividend yield sits near 1.66%, yet it's been growing payouts by about 20% per year while delivering 12.6% annual price gains. To balance things out, John added CubeSmart, a self-storage REIT. It pays a much higher dividend yield of 5.09%. Its dividend has been growing at a steady 12.51% annually, and while the price appreciation is slower at 4.2%, that higher income stream makes it the portfolio's income booster. Finally, the growth driver, Federal Agricultural Mortgage, or AGM. It combines a 3.63% dividend yield with an impressive 25% dividend growth rate and about 18.7% annual price appreciation. So those are the 5 stocks. The next step is to calculate the portfolio's dividend yield, and we'll keep it simple by assuming each stock makes up an equal portion of the portfolio. To find the average, take the dividend yield of each holding. SCHD at 3.88%, Morgan Stanley at 2.75%, Tractor Supply at 1.66%, CubeSmart at 5.09%, and AGM at 3.63%. Then add them all together. Once you have the total, divide by 5, since there are 5 stocks, and that gives you an average portfolio dividend yield, in this case 3.37%. It's a quick, clean way to see what kind of income the entire portfolio is producing. You can use the same simple averaging method to calculate the portfolio's dividend growth rate and share price appreciation. For this mix, the portfolio-level dividend growth rate comes out around 18.17%, and the annual share price appreciation sits near 12.04%. So with the portfolio in place, John wanted to see how it would actually perform over time. After all, theory is nice, but numbers are what matter when you're chasing financial freedom. So he ran the projections using the averages from his portfolio. He started simple, $10 a day, same way he did for the S&P 500. By the end of year 1, John would invest around $3,650. This sets the stage for future growth. After 10 years, the predictions show the portfolio growing to roughly $81,326, powered by both price appreciation and reinvested dividends quietly doing their job in the background. By year 15, the snowball starts rolling faster, climbing to around $220,421 with dividend income of about $1,169 per month. Then comes the turning point. By year 19, the projections show the portfolio crossing $493,325 and the annual dividend income hitting nearly $39,511. That's about $3,293 every single month. Goal achieved in less than 2 decades. Those small daily investments of just $10 a day would have built an income stream that covers John's freedom number. Breaking it down even further, the projections show that about $254,473 of the portfolio's growth comes from capital appreciation, while nearly $169,502 comes directly from reinvested dividends, adding up to a total of around $423,975 in value created over time. Seeing these numbers proves something simple. You don't need millions to start, just consistency, a solid plan, and time. Now, to put it all in perspective, John compared his dividend portfolio directly against the S&P 500 to see which one reached financial freedom faster. On one side, it's the S&P 500, the orange line. The other is John's dividend-focused portfolio, the blue line. Both start in the same place with just $10 a day being invested, but the paths they take couldn't be more different. The orange line moves upward almost in slow motion. For the first few decades, dividend income is barely noticeable. It takes 20 years just to cross the $2,000 a year mark. Even at year 30, it's still only paying around $4,000 annually. The real growth doesn't kick in until the very end, and by then it's too late for most people to enjoy. Only by year 68 does it finally reach about $38,500 a year, or roughly $3,200 a month, hitting the target. That's nearly 3 generations of waiting. Now look at the blue line. Instead of crawling, it accelerates early. By year 10, dividends are already climbing into the thousands. By year 19, it's paying out over $39,500 a year, more than the S&P 500 produces in nearly 7 decades. The shape of the curve is completely different. Where the S&P backloads all of its compounding into old age, John's dividend portfolio brings it forward into the years that actually matter. And that's the entire point. The dividend portfolio pushes compounding forward into the years that actually matter. It's not just about which one ends up bigger, it's about which one delivers freedom sooner. So, after seeing how $10 a day could reach the goal in under 20 years, John wondered what would happen if he pushed just a bit harder. Not by taking big risks, just by raising his daily investment to $35. That's about $12,775 a year. The projections show that after the first year, his account would simply reflect the amount he contributed, $12,775. By year 5, things begin to move. The portfolio value climbs to about $87,958, and the dividends start flowing at roughly $2,764 a year, or about $230 a month. By year 10, the compounding becomes clear. The projections show a portfolio value of around $284,640, producing $13,286 in annual dividends, just over $1,107 a month. Now, by year 14, the curve steepens fast. The portfolio jumps to about $633,351, and the dividend income reaches $37,977 a year, or roughly $3,165 a month, comfortably close to that $3,200 target. Out of the total value added of $454,501, about $300,645 comes from capital appreciation and $153,856 from reinvested dividends. When you line them all up, the difference is hard to ignore. The S&P 500 takes almost a lifetime to reach the same goal, about 68 years before the dividend income hits $3,200 a month. That's the slow, traditional path most people follow. With John's dividend portfolio, the projections show that the same target was reached in about 19 years, nearly 50 years faster than the S&P 500, a massive jump forward powered by higher yield and faster compounding. And when John increased his investment to $35 a day, the timeline shortened even more, down to around 14 years. That's a full 5 years faster, simply by feeding the compounding engine with a little more fuel. Want to know a step-by-step guide to build a dividend portfolio that can pay upwards of $10,000 a month, all with a daily $5 contribution? Click the video on the screen to find out.